The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Thanks for joining us. Today, we're going to go over some financial basics to try to give those who are just starting out in the real world a leg up. My name is Josh Bitel. I'm a client service associate within the financial planning department here at the Center for Financial Planning. And this presentation is especially important to me because I, like many of you that may be listening, am just starting out. I graduated college in 2015. And I definitely wish I would have learned many of the things that we're about to discuss with you. I'm joined today by my colleague, Kali Hassinger. She has a few more years experience than I do in the real world, so I'm sure she can provide some good perspective.
Hi, everyone. Quote unquote, few more years experience basically means I'm a little older than Josh, but thank you anyway for the introduction. I'm really excited to go over all of this information today because, as you'll see, making smart choices early in life can make such a huge difference in your financial future. We're going to try and keep it brief and concise today, but unfortunately, we can't take any live questions during the presentation. Our emails are included at the end, and Josh and I are happy to answer any emailed questions that may come up or even to be a resource going forward.
All right, so without further ado, let's get this started. So as I'm sure you're aware, millennials get kind of a bad rap sometimes, but as you can see, it's not exactly like we're starting out with the cards in our favor. So, the numbers on the screen here are from 2015, but I think they still tell the right story. Millennials are faced with some crippling debt and student loans, and that can consequently kill our credit scores. And the job market really isn't all rainbows and butterflies either. The millennial unemployment rate is about double the current national average.
If you're anything like me, these numbers are a little bit deflating and maybe even unmotivating, but luckily it isn't all bad news. Millennials had a front row seat to the recent recession, so I think consequently we've made some smart financial decisions and put ourselves in a little bit of a better place. So as you can see on the slide here, by age 27, 72% are currently saving toward retirement, even though studies have shown that millennials assume they're going to retire much later than their parents. 80% are using a working budget, and 51% have built up an emergency fund.
Right. So how did they get there, though? And we think there's a few really big steps and probably some small steps too that we can all take to try to get ahead.
And the earlier, again, that you take those steps, the greater the long-term impact.
So there's really two major building blocks when establishing your financial life. Most simply put, we got to have a firm grasp on our spending habits, of course, and then we need to know how to save money properly.
It can be so hard in such a commercially driven culture, especially with social media influences, to stop yourself from making some of those frivolous purchases or to save towards something like retirement that seems so far away and maybe even hypothetical at this point. But if you can establish the right behaviors and the right mindset this early in life, you'll be that much more likely to maintain those behaviors throughout your lifetime.
And the first step in doing this, and maybe the most difficult, I know for me it's definitely the most difficult, is to get organized. I can speak from experience that this can be pretty difficult.
If you're coming out of college, or even if you've been out for a few years, you may have several credit cards and student loans that you can hardly keep track of. Don't feel intimidated or avoid the issue. You need to take control, simplify, and get organized, and you'll just feel better about your finances overall. One of the first places that you'll want to gain that sense of control is with your checking account. It's so important to really understand what you're bringing in and what you're spending each month. Fortunately, we don't have to sit down and balance our checkbooks like in the past. Every bank has an app now, and you can see your balance, your transaction history, your deposits right on your phone, wherever you are, whenever you want. And thanks to technology, we also can easily access a lot of financial tools and apps, some of which Josh and I are going to touch on in a little bit. But one easy and effective offering with online banking with your checking account is to elect to receive transaction notifications. You can receive an email or a text every time you complete a transaction above a dollar amount that you choose. It's a good way to make yourself really think about those larger purchases or expenses.
I think it's also a good way to be notified if there's any kind of fraud or unauthorized purchases in your account. Obviously, that's something we'd like to avoid. And another thing you can do is elect to receive notifications if your balance falls below a certain level that you choose. This can obviously help you make sure that you're never on the hook for any kind of extra penalties or overdraft fees. And like Kali mentioned, apps are some of the most efficient and in-your-face tools that we can use to keep track of our finances every single day. I know personally I like to use Mint for my spending. You can quickly link this app to your phone. Well, it comes off your phone. You can link it to your bank account, your credit card, and it's a free app too, which is always good. The information feeds back and forth between the app and your accounts, and it's pretty cool because it can kind of show you exactly where you're spending. It'll break it into categories of different like spending categories. It can be kind of intimidating once you see it, and sometimes you're a little shocked on what you're spending your money on, but it's definitely helped me get a sense of how I can save some money.
When you use Mint, and I use it and I like it, you may receive some of those email notifications letting you know you're getting close to your budget, maybe shaming you a little bit and making you dial back on the spending. But there are some other options. You see YNAB here. It's an acronym for You Need a Budget. And it's just another option where Mint is fairly automated and it'll send you those notifications if you get close to exceeding your budget. YNAB really makes you account for every single dollar. So it makes you very intentional with your spending, and it's just a great option if you're looking at budgeting and tracking your expenses. Unfortunately, it's not free, but if you're serious about budgeting, the $50 a year may be worth it. And of course, it depends on what your needs are. So if you're more concerned about debt management, there are other options and other apps out there that could be helpful. Just do a quick Google search. We all have those resources available to us.
Another app that I can attest to and I personally love is Credit Karma. It's another free app. It's very secure. I know that's a common question when it comes to having to leave your social security number on anything, but it's a secure app. I've been using it for years. It provides a really nice way to see your credit score, and it's pretty motivating to see that score go up over time, at least hopefully go up over time. And I know that credit scores are such a mystery for a lot of us, and it's important to know your score and understand what goes into it. And this app does a really good job of that. It'll show you what is working for you and towards building good credit, and even what's working against you in regards to your score.
What is your credit score, though? Josh is right. It really is a mystery for a lot of people. So we just wanted to break down the very basics here. There are really 5 factors taken into consideration to determine your credit score, and they're all weighted a little differently. So as you can see, your score is determined by your payment history, the amount you owe, the length of your credit history.
And Kali, if I can interrupt, I think that this is a really important factor here, the length of your credit history, because a lot of us right now who are just starting out, this can lower our credit score, and it's important to know, and it's comforting to know that this isn't something that we're doing wrong, but it's just not working in our favor right now. But with proper management of our credit, we can definitely make this work in our favor over time.
Absolutely. And then lastly, they'll look at the new credit opened and your types of credit. So your student loans, for example, are going to be viewed differently than an outstanding credit card balance, for example.
And when you ultimately do open new credit lines or credit cards, however, just be aware of your limit and aim to only spend around 30% of that limit. So for example, let's say you get approved for a $10,000 credit line, only shoot to utilize $3,000 maximum of that credit line. This is an easy way to build up that credit score, and it's viewed very positively by the credit reporting agencies.
If you're in a position where you've already racked up some credit card debt, obviously you'll want to focus on paying that down, and you'll want to try to pay more than the minimum monthly amount. So the minimum monthly payment is usually only 1 to 3% of the credit card balance. So for example, if you have a $2,500 outstanding credit card balance, your minimum monthly payment may be only $25 a month. But with a 13% interest rate, which is in line with the current national average, you'd actually end up paying over $8,000, and it will take you years and years just to pay off that initial $2,500.
Right, and that kind of stuff actually blows my mind, like just how much you can end up paying in interest if you don't utilize your credit cards properly.
They aren't all bad though, of course. It's just a matter of using them correctly. You can build rewards, earn travel miles, get cash back. It's just important to be sure that when you are using your credit card, you're able to pay it off in full at the end of each month. So you may set up your credit card to pay your bills each month to build up those rewards, but make sure you have enough in your checking to pay that off at the end of each month. And another item to be aware of is when you're applying for a credit card, or if you get, those pre-approved flyers in the mail, a lot of cards have an annual fee, and it's really difficult to decipher if the benefits of those rewards outweigh the annual fee.
And building on that topic of rewards, there's also some programs that are offered through other institutions, like for example, a grocery store, that can also provide similar benefits and rewards just for signing up without any kind of financial obligation. I know for myself, one that I like to use and I really preach about is around here in Michigan, there's a popular grocery store called Kroger, and this is where I do most of my shopping. And I'll also, get a lot of the gas for my car at the Kroger gas stations. And if you just sign up for their rewards program, like I said, no financial obligation. You can build points towards discounts at the pump just for signing up and just for spending money at Kroger. I know I do it all the time, and anytime I go to the pump, I get at least $3 off per gallon, and oftentimes it's even more than that. And little tricks like that can really help you save some money.
I think
I got another life hack too. Yeah.
3 cents a gallon?
3 cents. Did I say dollars?
Yeah.
Yeah. Well, that's
that would be an amazing deal.
Yeah. 3 cents a gallon, not $3. I do have another life hack that I like to pound the table on. I get made fun of for it a lot, but I just like to tell people about it. So if you're ever in 7-Eleven or something and you find yourself you need some cash, you're nowhere near an ATM that supports your bank. There's those ATMs at 7-Eleven that are pretty generic, and they'll just to get out $20, you'll have to pay them $2.50. Your bank will charge you $2.50. So you're really getting charged $5 just to take your own $20 out. So one thing that I like to do, maybe go up to the register, buy a 99-cent pack of gum, keep it in my car, and elect to get some cash back. So therefore, I'll get $20 and a pack of gum for $21 instead of paying $5 to get my own money.
Guys, Josh was really excited about this tip, so if you do use it, please email him and let him know. He's going to be so proud.
It's my claim to fame. All right, back on track. So I really am often surprised by the number of people who just really do not understand student loans and just don't even realize that they have to start making payments on student loans so quickly after graduation. And I'm not kidding. Some of my closest friends are just completely oblivious to this. They didn't realize that they had to start paying their student loans so quickly. Typically, you'll get a 6-month grace period from your graduation date before these loans start coming due. It's just important to be aware when they're due and what kind of payments you have to make. But whatever you do, please just make sure you pay. This could really hurt you in the long run if you don't pay.
Part of the issue with student loans and why they can be so intimidating and so confusing is because we enter into these agreements when we're very young. We don't really understand what future payments will look like. We don't know what our income will look like, and it's really hard to understand how much interest you're going to pay over the lifetime of those loans.
I think one of the biggest differentiators to understand between the different types of student loans is whether they're funded by the federal government or by a private institution.
Most people will start out with federal loans. They're reasonable interest rates, and they have flexible repayment options when you come out and start making those payments. Some of the options are based on your income. Others are graduated, which means that your minimum payment will increase incrementally over time, which is, of course, sort of making that assumption that you'll earn more over time and you'll have the ability to pay more. But the good news is that you can change these payment schedules at any time to fit your lifestyle. So if you're kind of locked into a payment right now and you're having trouble making it, or maybe you think I could pay a little more, the repayment estimator online is a really great tool. You enter your loan information and it gives you an estimate of all the different repayment types, shows you the monthly payment and how much you'll actually pay over the lifetime of that loan. So it shows the interest right in your face, how much you'll pay. And like Josh mentioned though, whatever you do, just make sure you're making payments.
Right, and another tip that it often makes sense for some of us to put any additional payments that we can make into our loans to allocate them towards the loans with the highest interest rate. So if you have any excess cash floating around and you really want to pay down, those student loan debts, a lot of times with federal loan servicers, if you don't tell them how to allocate those deposits, they will just go right into paying off the interest first. When in reality, it's definitely a best practice to pay down those high interest rate loans first. So it's a good thing to keep in mind if you're paying above the minimum.
And private loans, on the other hand, they'll function more like a mortgage or a car loan. You're just given a flat monthly rate and a set repayment term, which will stay the same unless you refinance or consolidate. But if you have a few outstanding private loans, it can get confusing and it can be hard to keep track of them. But at annualcreditreport.com, you can get a printout of all your outstanding loans. So it'll include the federal, but it'll show you all of your private loans in one place together, which is just a nice resource.
Another tip that I like to talk about is, like I said, if you have some extra cash floating around, and when you're done paying out your student loans throughout the year, you're inevitably going to reduce the amount due on that payment each month because there's many different loans there, and you'll pay off one, and then you'll realize that your amount due is lower, and you may be tempted to just pay that minimum amount. When in reality, you'd be better suited to think of this as a fixed expense each month, so that even if you do pay off one loan, to just keep paying that same amount and allocate those extra dollars back toward that high interest loan like we spoke about earlier.
I know it can be really easy, at least I'm guilty of, when a fixed expense goes away, you just end up spending that cash somewhere else and not really using it to your benefit. But if you keep spending and keep paying that amount towards your student loans, you never actually give yourself a chance to get used to that extra cash and spend it unnecessarily.
Yeah, and like I said, ultimately you'll just end up paying off your loans quicker than that chosen payback period states. And obviously that's something that we should view as an advantage.
And now that we've talked about all the different ways we're spending money, we're paying bills, paying off our student loans, we still need to try to save some money too. And hopefully everyone has heard of the saying, pay yourself first, and it's probably because it's actually good advice.
Right, and life can be super unexpected. You guys don't need me to tell you that, but there's always costs that we really can't plan for 100% of the time. So if you're like me and you're in a single income home, there's really a good tip is to build up a cash savings account in the form of an emergency savings account. And the idea is to build up enough that you could pay your bills for up to 6 months. If something should happen, a situation arises where you are without income for 6 months for whatever reason, it's a good buffer to have.
And if you're in a dual income home, so there's two incomes, you could argue that 3 months of living expenses is sufficient, but that is making the assumption that you wouldn't both lose your jobs at the same time and that your incomes are somewhat comparable. So if one person in the household is earning significantly more, you should really increase that minimum savings to 6 months too.
So after you've saved up all that cash, now it's time to start thinking about investing.
This slide is such a great illustration how if you're able to start investing early, you can put yourself in a great position in the future.
Right, so let's look at Chloe here. She's up at the top left on that chart on your screen. She invests $10,000 a year from ages 25 to 65 and invested these funds in a portfolio that earns 6.5% annually. And by the time Chloe turns 65, her account balance is just under $2 million.
You can see her blue pie chart at the top right, and it shows that almost 80% of Chloe's account at age 65 is entirely investment return. If you look at Noah, on the other hand, he's in the bottom left in green. He also invests $10,000 a year, just like Chloe, but he invests it in cash from ages 25 to 65. This illustration assumes he'll earn 2.25% on that cash, and by the time he reaches age 65, he has just over $650,000. So even though he saved the exact same amount as Chloe, and they both saved throughout their lives, Noah is left with only 35% of what Chloe has for retirement.
Yeah, and even if you look at the other two examples, it really shows how effective investing can really be when you have a long timeline. If you even look at Quincy there in the gray, only invested for 10 years, so from ages 25 to 35. And he still ends up ahead of Noah, and his account balance is just under $1 million at age 65.
The last example here, Lila, you'll see her in purple. She starts a little later, but not by much. She starts saving at age 35, and she saves $10,000 a year for 30 years, earns 6.5%, but her account balance at age 65 is still less than Quincy, who only saved and invested for the first 10 years.
This is one of my favorite charts. I just think it's just such a great example of how compounding interest, especially over a long time, like 40 years, can really have such a huge impact on your portfolio, more than I think most people realize.
Of course, these returns are not guaranteed. It's just, like Josh said, a great illustration of why we're here to emphasize the importance of starting early and starting now.
So the way that most young people like us are able to afford investing and can start out and actually just get started with some kind of retirement fund is through some employer sponsored retirement plans. So if you're lucky enough to get a job that offers a 401k or a 401b or something like, or 403b, sorry, something like that, it's a good idea to contribute as soon as you can.
And another little thing you may have heard, hopefully have heard, is to contribute at least the employer match to your retirement account. And once again, you have probably heard it because it's true. It's good advice.
Right. And if you're not, if you're not familiar what an employer match is, and you're lucky enough to receive one from your employer, for example, let's say your employer agrees to match 4% of your yearly income. It's a good idea to at least contribute 4% of your income. Obviously, that's broken up between each paycheck. So that way, if you do, the employer matches the full 4%, you're essentially getting an 8% contribution to your retirement account.
And even if you're starting out at that minimal match amount, a good tactic to increase that is to just go up 1% each year. So start at 4, next year do 5. If the following you can jump to 7, that's great. You don't need to increase it, and it won't make it, you don't need to increase by that much, and it won't make a huge dent in your take-home pay, but over the years, you'll see that considerable contribution, and you'll be maxing out your 401k before you realize it.
And of course, once we've committed those funds to our retirements and made those contributions, we got to invest them, right? And a lot of providers will offer something pretty simple called the target date fund. This usually has a good allocation that fits your age, your timeline, and how comfortable you are with risk. And you'll have to select a year of the target date. Now, the year you select is the year of your projected retirement. Now, I know that's probably hard to think about getting just started, but for example, if you're 25 years old today and you want to retire at 65, a 2055 or 2060 target date fund would be a good starting point. And you don't have to get hung up on this. It's not something that you're going to have to commit to for the life of your plan. You can normally make changes during any open enrollment period, and employers offer those usually every 6 months or so.
And if you do use the target date fund, that's of course assuming that you're not planning to touch the retirement account until you actually retire. That may seem obvious, but everyone's plans are different. And if you do in the future come to a point where you may need to access some of those funds before you're 59.5, so when the government considers it retirement age, some 401ks will allow you to take a loan from the balance. You pay yourself back with interest, but these aren't designed for large loans. So the max amount you can borrow from yourself is $50,000.
And if you do decide to make an actual withdrawal as opposed to a loan, the government will tax you an additional 10% penalty tax. So this should probably be avoided at all costs and used as a last resort. It's also important, try not to focus on the account balance all the time. Just keep making those contributions and just know that your balance has years and years to grow, and it's going to grow a lot quicker than you probably think.
If you don't have access to an employer plan, that doesn't mean you shouldn't save for retirement. You still want to focus on that. And you can actually open your own accounts. There are 2 retirement account options that we'll touch on here. The first being the Roth IRA. You deposit funds that have already been taxed, and the account grows entirely tax-free. You pay tax now, and as long as you follow the Roth IRA rules, you don't pay tax on that money again.
Right, and another benefit of the Roth IRA, it does allow withdrawals prior to the age 59.5, only in specific situations. Now, I won't get into the weeds on those specific situations, like I said, but we do have some blogs on our website that show these rules, and of course, Kali or I would be happy to talk you through it if you want to email us too.
Yeah, absolutely. A traditional IRA, which we have shown here, is similar to a 401k. It's a good tool, again, if you don't have access to an employer plan, maybe you're working hourly or even just consulting and you still want to get a tax deduction. The traditional IRA, you get the tax deduction, it grows tax-free, and then you pay tax at withdrawal in retirement. So you may want to pick between the Roth or the traditional. It just depends on your situation.
Something to keep in mind, though, if you are going to utilize an IRA, is there are contribution limits, and they're far lower than other employer retirement plans. Excuse me. You can contribute up to $5,500 per year in either a Roth or traditional IRA, and that goes up to $6,500 down the road at age 50.
Yes, but with a 401k or 403b, you can contribute a lot more. You're allowed to defer up to $18,000 of your income each year.
So here's another slide that I'm pretty passionate about. So I'm currently studying to become a certified financial planner. And one of my favorite tips that I learned from my studies and one of the books that I picked up on is a rule of thumb that's called the 28-36 rule. The details are on the slide there, but to give you an example, let's say someone is making $36,000 a year gross salary, which means that comes out to $3,000 a month for a gross salary. Now, according to the 28-36 rule, you should be spending no more than 28% of your monthly income on housing expenses. That means, in this case, $840. Now, also stated in this rule is your total fixed expenses for the month. So that's including those housing expenses, but the other fixed expenses in your life should not be over 36% of your monthly gross income. And in that case, that would be just over $1,000. It's important to mention, though, that these are definitely the high end. So these are absolute maximums. That's what they're a rule for. If you are under those limits, that's probably a good thing, and you're able to budget much easier if you are.
Josh is passionate about this rule, and everyone is passionate about taxes. Just kidding. It's amazing how we never really learn about taxes in school unless you're studying to be an accountant. So we just want to give you some very basic information here and how it can pertain to you. Our taxation system is progressive, which means the more money you make, the more tax you'll pay on each dollar you earn.
Right, and how you withhold from your paycheck can really make a big difference when good old Uncle Sam comes knocking on your door on April 15th to pay taxes. Salaried employees are required to complete a Form W-4 as part of the job enrollment process. And you can see an example of what that form looks like here on that slide. Basically,
you're selecting the number of allowances that you can claim as a deduction.
And it might sound complicated and tough to understand, but the form, it comes with a nice little worksheet that they include it, and it helps you determine the number of allowances that would be appropriate for you. Just keep in mind that the more allowances you claim generally means the less that is going to be withheld from your paycheck. So if you don't select the right number of allowances right away, you may end up owing money when you file taxes as opposed to getting a nice tax return.
When you are filing your taxes, there is a fairly user-friendly program. You've probably heard of it. TurboTax is what I use. And you can actually file both your federal and state tax returns just on your phone or your tablet. It's really good when you're young and your situation is simplified. Maybe you're not ready to consult with a CPA. But the app really breaks everything down and is very user-friendly. You take a picture of your W-2, it pre-fills information, it asks you specific questions to see what your situation is, and it isn't free. You have to pay each year. The cost can depend on what state you're in, how involved your situation is, but they do offer a error-free guarantee. So if you get a tax penalty in the future and it's a TurboTax error, they offer that they would pay that tax penalty.
One more thing you may want to keep in mind when you're filing your taxes for the people listening. If you have student loans, you are able to deduct up to $2,500 of interest that you paid on those loans from your taxes in that year. However, keep in mind, there are phase-out, there are income limitations, so if your income reaches a certain level, you may not be able to claim that full deduction, and that limit changes year to year, so just keep in mind that there is a limit and try to be aware on what that limit is.
And last but not least, we just want to quickly touch on insurance. No one likes paying for insurance, but we all need it and we all like it when we have to use it.
And if you're under the age of 26, like myself, you may still be eligible to be covered by your parents' insurance. However, You'll definitely want to compare the coverages, figure out what is most cost effective for you and appropriate for your situation. Don't just assume that your parents' insurance is better because you're not paying for it maybe, but you definitely want to be aware that there could be some important differences.
Health insurance is kind of a news buzzword topic right now, but the bottom line is we all need health insurance, and we want to protect ourselves, and we also want to protect our property, which is, if you don't have a home, you don't need homeowners insurance, you're still going to want to obtain renters insurance. Some landlords and apartment buildings may require that you have it, but even if they don't, just look into coverage, make sure you get it. You can usually bundle it with your auto insurance, and sometimes you get a reduced premium packaging price, so it's really to your benefit.
So that about wraps it up for us. Thank you guys so much for joining us. I know we covered a ton of topics, and they were all at a somewhat broad level. So please, if you have any specific questions, please feel free to contact either Kali or myself. We're happy to help whenever.
Yeah, absolutely. Josh and I, happy to help. We have a Money Center blog here, which you see, we've mentioned it before, has a lot of great information, and it can be a good resource if you're looking for details on a specific topic. Just a reminder, everyone has to start somewhere, and you're not alone if you're feeling a little insecure or intimidated by finances in general. The fact that you're even listening right now means you're probably motivated and ready to get a handle on your finances. And I think we've reiterated it a million times, but the earlier you start, the better. And any place you start is a good place.
Right, and just to quickly mention, before we let you guys go, a replay of this presentation is going to be sent out in the coming days. So please feel free to share this with anyone you think could benefit from it. We'd love for everybody to hear this. And thanks again, guys, and good luck out there.
Thank you.